Dad, the bank pays me 5% but charges Tyler 22 on his credit card. That's not a fee, that's a crime.
Not a crime. A business model. And once you understand it, you'll never let it happen to you.
Tyler has been paying that card for 6 months and the balance is the same.
That's the trap. Sit down. This is the most important math class nobody teaches in school.
Okay. Start from zero. What even is interest?
Interest is rent on money. You lend your lawn mower. I pay you 50 cents. You lend me $1,000. I pay you rent on that cash.
So the bank rents money. And Tyler borrowed some. So the bank is Tyler's landlord?
Exactly. And Tyler's paying the bank 22% rent per year. On money he already spent on sneakers.
Those sneakers now cost like $122. Except he'll pay it forever.
If he pays only the minimum. More like 5 years and double the price. We'll do that math in a minute. You will not enjoy it.
Why do banks say APR sometimes and APY other times? Is that just alphabet soup to confuse me?
A little bit, yeah. APR is the stated annual rate. APY is what you actually earn once you factor in compounding. APY is always the real number.
What's compounding again? Is that the snowball thing?
Exactly, the snowball. Interest on your interest. $100 earning 5% becomes 105. Then that earns 5%. It stacks.
Okay, but that's good when you're saving. For Tyler it's, the snowball is chasing him.
That. Right there. That's the whole lesson. Same math, completely different direction.
So where does the bank get all this money to lend out? They just have, like, infinite cash?
You deposit $100. The bank keeps 10, and loans out 90 to someone else. That someone deposits it. Bank keeps 9, loans out 81. It multiplies.
Wait. The bank lent out my money? And they didn't tell me?
They did tell you. Page 47 of your account agreement. In size 6 font. Single-spaced. But yes.
No wonder they give you a free toaster. They owe you a toaster.
Look, it's not nefarious, your money is insured, it comes back when you ask. But this is how banks profit on both sides.
Who controls how high the rates are? Someone decides 5% and not 3%, right?
The Federal Reserve, the Federal. It's the bank that banks borrow from. When the Fed raises its rate, every loan in America gets more expensive.
So the Fed sneezes and Tyler's credit card rate goes up?
Basically, yes. Fed raises rates to slow inflation. Raises rates to cool off an overheating economy. It's a giant thermostat for money.
Okay. Tyler's debt math. I'm ready. Probably.
Tyler owes $1,000 at 22%. Minimum payment, $25 a month. Guess how long to pay it off? 7 years. He pays back $1,800.
He paid $800 for the privilege of owing $1,000?
And those sneakers are long gone. That's the trap. The minimum payment is designed to keep you paying forever.
What if he paid like $50 a month instead of $25?
22 months. Total paid, $1,100. Double the payment, saves $600 and 5 years of misery.
So interest is evil and I should never borrow anything ever?
No. When you are the bank, when you save and invest, compound interest works for you. Same math, opposite direction. Tyler's problem is the rate and the minimum.
The rule is, earn interest, don't owe it.
I'd put that on a bumper sticker. There's one exception, mortgages and student loans at low rates can make sense. But that's a whole other episode. So what do we know now?
Interest is rent on money. Banks lend out 90% of deposits. APY is the real rate. And Tyler needs to pay more than $25 a month.
Send Tyler a spreadsheet. It might save him $400.
Tyler barely opens texts. He definitely won't open a spreadsheet.
Then send him this video. Next time, where does your paycheck actually go? Taxes, and why they're not as simple as they look.